Forget trigonometry. In this episode, I'm going to teach you something they should teach you in school. Understanding your credit. Hi everybody, welcome back to another video. Today we're going to talk about credit and exactly what it means from a bank's perspective. And a lot of people don't realize there's actually 5 C's to credit. The 5 C's of credit are simple. It's capacity, it's capital, it's collateral, it's credit, and it's character. Now I'm going to break those down one by one. So the first C is capacity. Capacity is exactly what it sounds like. It's how much debt, what's the capacity of your debt load? And it looks at 2 major things. It looks at GDS, so your gross debt service ratio. That's really just all the associated costs with owning the house versus your gross income. And then there's TDS. So TDS is total debt service. That factors in the GDS, so that all the housing costs we're considering, plus any other monthly obligations like credit line, credit card payments, loan payments, things like that. So that's capacity. It's basically your gross income versus the debts that we're considering. Now the second C is capital. So capital is really just your capital investment. So how much money are you actually bringing into the investment? So for a regular purchase, if you're talking about financing your first home, you have good credit and it's affordable based on capacity, then we really look at your capital and you need as little as 5% down. Obviously, if you're buying something else, if you're buying a revenue property, you may need more down payment. If you've had credit problems, if you're missing or you're lacking some strength in some of the other C's, you may need more capital in the investment. So the easiest way to think of capital is how much skin are you actually putting in the game in the way of a down payment. So C number 3 is collateral. And collateral, it's in the literal sense. So collateral is how many other assets the borrower has that the bank could potentially leverage and secure security against when considering against the borrowed money. So if you're borrowing money and you have other forms of collateral, maybe you have other properties, maybe you have land, that the bank could take additional security on so that they feel more confident or they feel more secure in lending you more money. So collateral is really what else you're bringing to the table that might add additional security. So C number 4 is the big one. Probably the one you're most aware of, but I want to elaborate on it a little bit. C number 4 is credit. So this is where the bank looks at your credit history and they look more importantly at your repayment history. A common misconception people have with some of their debts, revolving credit like credit lines and credit cards, is they're like, okay, it doesn't really matter if I was 2 or 3 days late, that's no big deal because I actually ended up paying substantially more than my minimum payment. There's a right and a wrong there. It's great that you're paying more than your minimum payment, but when some other lender is considering borrowing you money, they want to see that you had an obligation on a certain due date and that you met it. So this is where your credit really becomes vital for us, is the lender wants to look at it and based on the other money you have out right now, are you making your payments on time? And are you managing the money you've already been borrowed appropriately? So when the bank reviews your credit history or when we're showing your credit report to a lender, we want to make sure that we're showing them that, look, you want to give our client money because based on their history, they can be trusted with anything they're given. That's credit. Now the last one is actually one that a lot of people don't even realize that banks still actually consider. It's character. And character is basically just you and what they see. Now you're kind of thinking to yourself, well, wait a minute, the bank doesn't know me from a hole in the ground. You're absolutely right, that's right. But here's where they look at things like job history. Do they change jobs a lot? Are they hopping from job to job every 4 months? Why don't they commit to anything? There's always valid explanations, don't get me wrong, but if you have a history of hopping from job to job, that's where character could come into question. If a bank is considering giving you money over a 5-year term, but you're changing jobs every 4 months, you could probably see how that might make them a little bit nervous. Also with character comes down to address history. Are you able to hold down a steady address, or are you renting and maybe changing apartments every 2 or 3 months? So they also want to see that not only do you have a long-term job and you're able to commit to employment, but you're also able to set some roots and you're not nomadic all over the place. And then finally, character also comes down to your credit, not just your payment history, but if you've had collections, how quickly you went to pay them off, or did you just let it ride for a while because you figured, well, hey, I don't need credit anyways. So character really comes down to the story that your application tells based on the details within it. So that's character. So there's our 5 C's, guys. If you have any questions afterwards, check out the comments. There's a million ways to get a hold of us. If you haven't subscribed to our YouTube channel yet, all the details are in the bottom. And if you got any value from this whatsoever, which I hope you did, don't forget to hit that share button. Thanks, guys. We'll see you again on our next video. Have a great day.